Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special edition, and our focus will be on the pharma space, especially Lupin, which has come out with its strong set of numbers this time around, 74% year-on-year surge in its consolidated net profit at 852 crore rupees. We've also seen that the revenue has come in at 5,672 crores. That's also up nearly 13% from the year-ago period as well. We've also seen that the North America sales have been up by 5.5% odd. That's accounted for almost 36% of Lupin's global sales this time around. India formulations business has also stood at 2,000 odd crore rupees. That's up 18.8% as well. And that's accounted for about 37% of the global sales as well. What we've also seen on the operational level, the EBITDA has come in at 1,382 crores, and that's a strong 44% uptick from the year ago period. Margins have come in at 25.2% as against 19.4% in the year ago period. What we'll do is we'll get down to understanding what has been the key contributing factor for the strong set of our earnings in the quarter two of FY25 from the top management who's joining right in. Warm welcome to you, Mr. Ramesh Swaminathan, Group CFO. Lupin is now joining in. And help us understand, sir, first, congratulations on this strong set of numbers. Could you elaborate for us two or three key reasons behind the growth drivers? We've seen a very strong surge on the bottom line. What has led to that?
Well, thank you for having us on. And of course, we are pretty happy about our own performance in recent times. If you notice, we have actually been growing quarter on quarter, successive quarters for the last 6 quarters, so to speak. This is essentially because we got our mojo back when it comes to the top line. Top line buoyancy is back with on the back of, in fact, a host of products across various markets. And that's what accounts for the secular growth. When you speak about America, which is by far the most important market for us, close to about 35% of our sales, in recent times, we've had a good crop of products coming up. And more particularly, if we speak about this, this quarter, for example, we had Mirabegron 50 mg. Previous, quarter, we had launched Mirabegron 25 mg and the like. We had doxycycline as well. So all of this have contributed, but, and this is also on the back of, in fact, our emphasis on getting into more complex stuff where the price erosion has always been is lower. That's the respiratory space that I'm alluding to. So we have a good round when it comes to albuterol and, of course, Spiriva in recent times, but we've also have a host of other products, Zopinex, Brovana. You're speaking about actually products like Foster when it comes to Europe. And the emphasis on actually creating global platforms, so to speak, has really paid off big time with secular growth across various markets.
That's very true. I was actually about to understand a little bit more on the complex generics that you just alluded to, which is going to be your key focus now. What are the key challenges and opportunities you're foreseeing in maintaining the kind of growth that you are seeing right here? And are there any levers to further the growth going forward in these segments?
So when it comes to the next few quarters, so we have, in fact, there's going to be a lot of emphasis on actually launching products that we have developed and filed for. So the respiratory portfolio, and that already is about 35-40% of our global, portfolio, so to speak, which will continue to be the cornerstone of our progress in the quarters to come as well. There is actually no product which is not worthwhile, which you're not working on. So we're working on really every product in that space. We're also working particularly proud about, in fact, our platform on complex injectables. So we have this Nanomi platform, which is good with, in fact, Risperdal Consta. We have filed for that as well. It's a reflection of, in fact, a success in something which is very complex and unique. And we would use that for a host of other things going forward. But we also are filing for a host of other things, not necessarily from this platform, but from other platforms, which would help in bolstering our overall injectables portfolio. We've also been, over time working on, building up a biosimilars portfolio, which is not necessarily reflected in the numbers as yet.
Okay.
And we have always professed our interest on the complex, on the specialty front. So of course, I have nothing to speak about at this stage, but that's what will build the future. But coming back to, in fact, the portfolio, next year we are looking at, Tolvaptan, which is of course going to be a pretty big launch. And as I said, the other products that we have on the OSD front, which we filed all of this will, for example, you have Bradford, which would be another complex one that you'd be launching in the quarters to come. And of course, the sustenance of, in fact, the existing portfolio. And I would also like to comment about the fact that the the erosion is used to be plaguing this industry for quite some time.
Yes.
And it's a little more, hostile, less hostile now. It's a lot more benign.
Okay.
Given the fact that a lot of companies have shed their portfolio, leading to a shortage in the market. And from that perspective, I think there is a dawning on behalf of the market and the authorities, of course, that manufacturers would not shy away from shedding portfolio if things were bad on the pricing front. In some ways, the interest rates have also contributed, because a lot of companies that kind of levered their balance sheets and with the interest rates rising, things were unprofitable, and they closed down factories, and the supply situation being what it was, helped in building up a pretty benign price erosion front.
Also, just to get a sense, in the US, we've actually seen your sales grow by about 5.6% this time around. With the elections uncertainty now out of the way, there is a clear path ahead that Donald Trump will be looking forward to the policies, especially in Indian stock market. Experts have been analyzing two key potential benefiting sectors from the new regime, and that is IT and pharma, which are the export-oriented sectors. I just wanted to get a sense from you. Do you think things going better for the pharma industry as a whole in the US now?
Two things that need to be said about this. The fact is, every government which comes in really has to cater to, in fact, affordable medicine for its population. And from that perspective, this industry, being all about affordable medicine, will always have a good run, irrespective of the regime, be it a Democrat or be it a Republican, so to speak. So things will not be very different. The other thing which I would also stress is the fact that there is this nationalistic fervor which is actually prevailing across not necessarily America, it's across all markets really. So they would like, in fact, factories in their own geography, and a lot more. And they would like to call it as a strategic initiative, so to speak. And perhaps that is something which will happen with the Trump regime as well. But given the fact that the cost of production in those parts are going to be very, very different, the economics might not really work out very well. So I think there is going to be a fair alliance when it comes to supplies from India, and that's why I think the future of this industry is really secure. There's of course the other thing about API supplies and the like, with the growing realization that there has to be alternate sources of supply when it comes to that. There again the China plus one kind of strategy clicks in, and I think countries like India would always be beneficiaries of this as well.
Okay, wonderful. To also tell us on your expenditure part on R&D, I think we've seen the expenses rise to about 8.2% of sales. Could you discuss for all our audiences the key strategic priorities in your own pipeline and any key upcoming product filings that you'll be looking at?
This is in line with our philosophy of actually pivoting more to complex. We just spoke about it at length. So close to about 60 to 70% of our spends is really going to be on that, and that's actually evident in this. We see it more as not an expense, but more as an investment for the future. It's really a bloodline for the future, and from that perspective, we are happy about it. The issue is, would it actually impact so much our margins? The one way to look at it, add back that expenditure and look at how the margins are behaving, and I think it would exhibit an upward trend. But the other thing that we would also be doing is focusing on a host of other lines, apart from, of course, the R&D, which is essentially the SG&A part and a host of things which go into making of the product itself, better productivity on the work, at the factory level, alternate vendor development in order to keep the cost down on the input front and so on. All of these strategies have paid big time, so essentially there has been continuous improvement of the gross margins, apart from, of course, the contributing factor being the newer products, which is the sales mix. But I think one can't take away the fact there's been a lot of focus on this, and it's yielded us rich dividends.
Absolutely. So when we talk about the margins, like you're pointing out, what is the kind of outlook that we can expect? Strong surge is what we've seen. Is it going to be sustainable? Are you comfortable with that 25% band? Will it be able to sustain around these levels in H2?
Yes, we're comfortable, but we are never complacent. we're not going to rest on our laurels. I think there is going to be more work to be done. And I think we've also drawn up a 3-year plan where we're looking at more savings on across various fronts, the procurement front, the conversion front, the supply chain initiatives and the like as well. And those initiatives will continue to bear fruit, and you would see the margins, rising. And of course, this is going to be a continuous effort.
Okay. Do also share with us, on the debt part. Lupin's debt has dropped significantly with the low debt to equity ratio about 0.02%. Are you comfortable with this? Are you planning to leverage this position for future investments? Probably take on more debt? How is the exact planning of the company?
Yeah, so from our perspective, we're very comfortable with this position in terms of, having become a near debt-free company. So that was actually the case last quarter. This quarter we put on a little debt because of the fact that the working capital went up marginally in about 5 days, so to speak, 102 to 107 days. And there's of course the dividend outflow, which actually brought this in. But we don't really believe in in being a debt-free company, because I think it's important to have some debt for trading on equity. It actually enhances the equity, the return on the equity, so to speak. We've always been an acquisitive company, looking at acquisitions and so on. So if it's a compelling proposition in India or in America or other parts, which you think is is worthwhile from our perspective, you'd certainly be looking at it. So I can't promise a debt-free existence forever. I can certainly say that we would do what it takes to kind of enhance our equity. And that augurs well, really. But it's going to be calibrated aggression. It's not buying at all costs. It's buying at a cost which is affordable and a good return for our monies.
Sure. We've seen US perform at 5.6%, Indian market also growing at about 18% or so. Your EMEA market has also seen double digits as well. Are there any region-specific strategies that are driving your success in these key markets? Are you also planning to enter any newer markets right there? What's going to be your key focus for FY25 H2 and FY26?
But it's a simple enough philosophy: get the best markets, best products for all markets, and essentially, and that would and focus on being the best that there is in from a quality perspective, from a supply chain metrics perspective, and the like. And that's proved to be very advantageous to us when it comes to America or any other market for that matter. India, of course, when you speak about 18%, it also includes, in fact, the entire gamut of sales emanating from local supplies for global TB and the like as well. Or for that matter, the adjacencies. So all of this put together, obviously, things are turning out to be pretty good for us.
Right. So do talk to us about the forex gain and losses that have impacted this time around. How are you really looking to hedge against the currency volatility, and what are the expected impacts in the coming quarter?
The good thing about it is the fact that we are entering a phase where things have been relatively stable. So it's not as though it's a continuous depreciation of the rupee, though of course it's always beneficial for us. And if there is, so rupee depreciation helps the exporting, export units, and a huge chunk of our sales actually comes from exports. And from that perspective, it's certainly pretty okay from our perspective. We do hedge, but we take our bets selectively based again on what is going to be, what is the outlook, so to speak. And we will continue with that philosophy, given the fact that it's not going to be very choppy. I think, you might see some mean reversal. There's of course in the last couple of days there has been rupee depreciation, but so it's of course because of the overall outlook in various parts and so on as well. But
Okay.
very solid hedging strategy for sure.
Okay. So lastly, just wanted to get a sense on the overall FY25 outlook. What is the kind of guidance that you could share with our viewers, as well as comparing it with FY24? What is the kind of growth that we can expect?
At the beginning of the year, we did guide for, in fact, steady increase on the EBITDA margins front. We said it's going to be between the 20.5% to 21%. We started off with that, but then what we said, he said it'll be upward of 21%. Given Q2 and the buoyancy continuing, etc., I think we would be happy to state it should be anywhere between 22 and 23%. But irrespective of all of that, I think the more important takeaway would be the fact that there'll be tremendous focus on bringing in the right products as well as on containing the cost, and which would actually result in a pretty healthy margin in the quarter quarters to come, and perhaps to the medium term as well. I think the medium term, you should be looking at close to 25%, 2 to 3 years from now.
Okay, wonderful. Well, on that note, thank you so much, sir, for explaining to us the key insights from the quarterly earnings. And again, congratulations and all the very best for the upcoming quarters as well. Hoping to catch you around the next quarter to really understand how have we progressed from here on. Thank you so much. Appreciate your time.
Thank you very much for having us on once again.
Thank you. With that, viewers, we wrap up this special conversation from Lupin as far as the earnings insights go. I hope this has given you enough and more clarity from the pharma space as well as on Lupin and how this is progressing going forward. We will continue to get you all the insights. Stay tuned on Business Today Television.